The manufactured housing space is actually really interesting because it actually started as trailer parks in like the 1950s. And that's when people were, kind of wanting to travel. They're wanting the mobility of getting here and there with their homes. And then after World War II, the need for affordable housing skyrocketed. And because trailer parks had become this huge thing at the time, people started converting those into their homes, their long-term homes. And that's how mobile homes became more popular. Just kind of grew from there. Manufacturers started building more homes. So it was kind of like this unmarked territory. Manufacturers could do whatever they wanted, operators could do whatever they wanted. So there was a stigma that kind of started to grow with the space. Around the 1970s, the federal government started putting in standards. And that's when we started to see a little bit of a shift in switching from mobile homes to manufactured homes.
Manufactured housing, if you could look back at mobile homes, they're existing all the way back to the Civil War, maybe even some before that. Heck, if you even want to look at, for example, pioneers crossing the plains, it's an example of a mobile home, of homes that were built somewhere that were made to transport other places. The modern age really dates back to the mid-70s when HUD standards were implemented. Before that, mobile homes were very much kind of a subset of RVs. They're built without standards in place. You see that at a lot of these older homes that are 1950s, 1960s homes. They're much smaller. They don't have a lot of the livable standards that we see today. So in the mid-70s, the government put standards in place so that homes have to meet certain criteria of safety, of quality, of compliance that continues to evolve today. Some of the more recent things we've seen is just in regards to energy efficiency. New standards are being placed on that. A lot of manufacturers are trying to even get ahead of the curve on becoming Energy Star qualified, so on and so forth, so that they can provide a little bit more incentive, but also with the understanding that some of those qualities might become requirements, so you might as well get ahead right now. One of the things I think that is amazing about the industry is just how high the quality of the homes are. I think so many people look at manufactured housing and think trailer park. And that's really not what it is. Because of the standards that are in place and the quality of these homes that are going out there, this is a fantastic option for people that maybe can't afford traditional site-built homes, especially as costs continue to increase, as interest rates continue to go up. Manufactured housing is more attractive than ever. When you get a chance to go into some of these homes, it's shocking. I remember when I first came into the industry, I thought I was getting into the trailer park industry. I show up on the first day, started doing some property visits, and noticed how, oh, this is not a trailer park. These are really nice, high quality homes.
Before hearing about Roots, I didn't even really realize manufactured housing communities were still a thing. I grew up in Wisconsin. I actually lived in a trailer park or in a manufactured community when I was really little, but I don't remember it. So it was totally off my radar that that was even a thing to have, these communities. And stepping into this space, the people and the culture has completely changed my work experience. I mean, I love coming to work and I love the people I work for, but it's also completely changed the way I look at the manufactured housing space. I would say prior to working here, when I heard manufactured housing, I would think trailer trash, unsafe communities. And coming here has really opened my eyes to what we can offer people when it comes to housing. And the main problem has always been affordability. Once again, going back to World War II, that was one of the biggest needs, was affordable housing. And this space specifically makes it a lot more affordable because it's built in a factory where you can control the environment. You have the assembly lines, so you can do more efficient, streamlined processes. And then you also can do bulk orders.
Treehouse Group was the original company formed to acquire and manage manufactured housing communities. That was rebranded in 2018 to Treehouse Communities. We brought on a couple new partners at that point and rebranded, merged with Vineyards Management Group to form Roots Management Group. We operate manufactured housing and RV communities.
Part of what I do as the construction controller, I oversee all of our home sourcing. So everything that involves purchasing homes, getting new homes, and bringing them into the communities to fill up vacant sites. In addition to that, just for the entire team, I oversee our financials, making sure that we're staying within budgets, that we're using our cash most effectively. So looking for opportunities where it makes the most sense, especially when we have limited cash. Where does it make the most sense to use that? We can't, for example, if we're going to spend our money to do a project somewhere in one home or in one property, that means we might not be doing that same work on a different property. And so trying to figure out where are we going to get the most bang for our buck, how are we going to provide the most value for our investors, for our company as a whole, and just for the residents as well. We base it a lot on occupancy. One of the phrases that we use here at the company is that occupancy is oxygen. So for that, we look at what are the properties where people are increasing occupancy, where's the highest demand. That's not to say that, in a perfect world, we'd love to do projects and make every single property perfect, but that's unrealistic. And so we look at where do we have the most opportunity to increase occupancy. So for example, we have a property called Eagles, and at that property, occupancy is increasing very fast when they have the opportunity. One of the things that stops the occupancy from growing is that they don't have homes to occupy. All the homes are fully occupied. So in that case, we look at, they have vacant sites. Let's put some more homes on there. They have vacant homes that aren't ready, that need to be renovated. That's where we should go focus. Now, that's not to say we ignore those other properties. We're still gonna put work into those properties so that we can improve those and make it better, so that even though maybe it's less desirable now, we'll still put effort into that so that they become more desirable. We don't want to stall that. If there's a lot of demand somewhere, we don't want to hold up occupancy because they just can't get homes, so they can't get homes ready. We want to do what we can to make homes available so that we can meet the full potential. Going from a vacant site to an occupied home, it can vary. It varies all the time depending on what's going on in the industry. So for example, during 2020, once the COVID pandemic started, lead times with manufacturers went all the way up to 18 to 24 months. So it's taking us 1.5 to 2 years just to get a home from a manufacturer. In addition to that, typically to get a home ready to occupy after it arrives on site can be anywhere from 60 to 120 days, depending on the market. However, over the last about 1.5 years, the market has changed. It's become a lot more easy to get homes. Lead times have become a lot quicker. So for example, even some manufacturers in some markets, we can get a home in 2 weeks if we wanted it. And so it changes all the time. Usually when it steadies, it's about anywhere from 3 to 6 months to get a home is kind of the standard, what I would consider the standard lead time. It's good because that gives you time to get the sites ready for the home. Once you order the home, basically you spend the time getting the sites ready, getting contractors set up so that the moment the home arrives, permits are in place with the local municipality. They can get right to work on getting the home set, installed, utilities hooked up, so on and so forth. So the home can pass inspections, be declared livable. I guess start to finish, if you look at it from 3 months to get a home, maybe another 3 months to get the home ready, we're looking at about 6 months.
The process from start to finish can go pretty quickly, as long as you are getting all the information, all the conditions in at a timely manner. So from a residency standpoint, that is done through the community manager, and you would have to apply directly through our leasing company because you are leasing the land. So you do have to qualify for that lot lease and that lot amount. So that process can take 24 to 48 hours depending on how quickly your background check comes back. From a financial application standpoint, it can take anywhere from 15 to 30 days. Just honestly depends on how quickly you get those conditions in. So once we submit that lender application, you should hear back from those lenders in a timely manner. Typically we hear back 24 to 48 hours for an approval or a denial. Upon that approval, you'll be receiving a list of conditions, and those conditions are what gear you to the next step to scheduling that closing date. So it's all dependent on how quickly you get those conditions in.
What we do is, whether it's cash or finance, the title transfer will always be done through us. If it's cash, that title transfer, it's going to depend on how long it takes the state to transfer your title. But once we get that title back, yes, we'll give it to you as soon as we get it back. If it's a finance deal, the lender will hold on to that title until you've paid off your loan. Yeah, as long as it's specified in the closing documents, right? So just like when you buy a home or you rent a car, things like that, right? You want to walk everything with the person that you're buying it from. So in this case, the community manager or the salesperson. And I see a ding in the paint. I need that touched up, or the door's got a dent in it. I need that fixed. Everything would need to be noted on the purchase agreement, and an agreement would need to be made on that purchase agreement between you and the seller, us, as to when those items were going to be taken care of, whether it was before closing or after. Because at that point, you own the home. It's your responsibility to fix.
Really candidly, like as we sell homes, we use those sales proceeds to invest back into the community and to fix the roads and to trim trees. And that's also just like a mutual benefit, right? Is when we look at the long-term success of the communities, it's communities where roads are paved, that provide amenities that residents want. The sales proceeds are used to invest back into the community.
The simplest thing is monetarily. It's typically going to cost less money to own a home than it does to lease or rent. So if you can get in that same manufactured home and actually own it, your rent payment or your payment should be less than what you were paying in rent, dependent upon the situation. You can structure a loan on a home to be shorter in term. So if you have the ability to make higher payments, you don't have to go with 10, 12, 15, and 20 years. You can go significantly less than that and own it sooner. But if you're strictly looking at a month to month, what are my expenses and what is my income, it should be more affordable to own most of the time. Because a lease involves risk for the owner of the property. So if we own the land that the manufactured home is sitting on and we own it, the manufactured home itself, we have skin in both of those games. You as the owner have the upside of very favorable lending terms. We as a management company are not seeking profit from you owning a home. So the bank is going to have a little bit in the form of an interest rate, but there isn't an asset there that we need to earn anything on. So quite frankly, you've taken some of the work off of us and you're putting those dollars right into your pocket. It's an asset that we don't have to manage because you own it. It's your asset.
Statistically, we've seen that homeowners stay at the property much longer than a rental. Other things to note is people take pride in home ownership. Typically, if we have rental units, what we find is once the person moves out, we have to spend a lot of time and money just fixing the home up, turning the home, whether it's minor repairs or sometimes it's major repairs that we have to take care of. Whereas if someone owns a home, it's their home. They care about it. They take ownership in that. We see that not just on the inside. For example, there's been times where homeowners have left, and for one reason or another, we've had to reacquire the home. Typically, the quality of those homes is much higher than what we see on the rentals. Even if it's been a homeowner that's been in a home for 20 years, compared to someone who's renting a home for six months. Another thing that we've seen is just on the exterior factor it plays on the property. When someone owns a home, they take care of the yard, they take care of the land that the home's sitting on, compared to a renter. A renter doesn't care about that stuff. They're just there to have a place to live. Generally, if someone's a homeowner, they're gonna take care of everything around that, and that increases the overall look and feel of the property, of the community as well. We're willing to approach the industry with more of an innovative mindset. We look towards the future. For example, I think in the industry, so many players look at it as, well, this is the way that it's always been done. It's very much an old industry. It's a very set industry in its ways. But one of the things that I think makes us unique here at Roots is that we don't look at it that way. We look for best practices wherever they come from. And so I think it's something that's made us very unique and very valuable. And something I think that's also impacting others in the industry is that we want to do things a better way. We don't want to do things a certain way just because it's always been done that way. I look at even with some of the manufacturers that we see that with them, that many are set in their ways. We've spent a lot of time working with manufacturers saying, we want it done this way because we think it'll be better that way. And then to see those manufacturers actually adapt in those ways and say, we've heard you and we want to make some changes, and it's just been beneficial all around. A second thing that I think we do at Roots that really sets us apart is our emphasis on the community manager. We put our focus on the face of the company. We say the community managers are the ones that are interacting with all of our residents. They are the ones that really make things happen. They're the ones that increase occupancy. If we go back to the idea that occupancy is oxygen, the community managers are the ones who are giving us that oxygen. And so because we invest in our community managers and their development and their success, we provide, as a corporate team, we exist to be tools, to be assets to help them. Because we've taken that approach, I think it's made us very unique and very impactful in how we can achieve the goals that we're trying to go after.
Typically how it works when you apply with multiple different lenders, if you apply with 3 lenders at a time, it consumes it into one hit on your credit. Typically our lenders use a soft credit check until we get down to the nitty-gritty and go to close the home, and that's when they pull that full credit report to ensure that everything is within line, they collected all the right conditions, and they took in all measures before closing the home. But yes, it combines it into one if there's 3 lenders that you're looking to look into, but they are soft credit checks until we get down to the nitty-gritty.
Yeah, absolutely. Again, I'm going to use myself as an example. If I want to come in and see if I can get approved for $50,000, what do you have available, right? I've already gotten that pre-approval process done, just like in the stick-built world. It's the same thing. So absolutely, 100% yes. The lender would only apply the sales price to their loan. The above and beyond, we haven't seen a lender yet that is doing what we call HELOC loans, which would be home improvement loans, things like that. We haven't seen one. They're asking the value of their home on the current market. Yes, they can. Generally speaking, they can run a few things. If they look at a website called NADA, and it's the same thing as, again, a car, right? It's not a blue book value. NADA has a site for manufactured housing. Generally speaking, they'll let you run one for free. Otherwise, that NADA site will charge you, but they can find what their potential house is worth. They can also do what's called a comp search, where they can look at homes in their specific area and what they might be selling for. Similar year, similar make, and kind of get a rough estimate of what their house might be valued at. On our end, as far as us being the seller, there are not. However, the lender will require some fees at closing. Generally speaking, the lender will roll all those fees into their loan. So there shouldn't be any other, aside from the down payment, there shouldn't be any other fees. The one fee that we do charge at some of our properties is a processing fee of $300, but it is property by property. We always want to have the first right of refusal on your house. However, I would argue that, you'd also want to entertain other offers just like we would, right? The biggest thing is that we don't want to see any homes moved out of our communities, right? Because that's going to create an empty lot. That's just not what we want to see. Again, we want every lot maintained, every lot kind of kept in our property. But we also want to make sure that you're getting the best price for your home. It's always good to do a resident-to-resident sale, is my opinion. Generally speaking, the answer is going to be no, because again, we want to go back to that first right of refusal. However, if you do decide that that's something you want to do, you've bought a plot of land, the only, downsides that I would remind people of is that it is very costly to move one of these homes. I would say the cheapest that I've seen is about $10,000. And it's all going to depend on the age of the home too. Any of these homes that are pre-HUD, meaning 1975 and older, forget about it. It ain't moving. It's staying in the community. And then anything that's newer than that 1975, you're in that $10,000, $15,000 price range. So is the home worth it to move? I don't think so. So chattel loan mortgages and regular mortgages. Chattel loan mortgages are mortgages where the home isn't tied to land. So they don't own the land that they're on. Whereas a regular mortgage, they own both the land and the home. So that's generally speaking, why the rates were higher previously, because that home could be moved at any time, right? And so the lender, in order to kind of ensure their value in the home, they would raise those rates. Is it right? I don't feel like it is, but they have the niche in this particular industry. So now we've gotten, the feds who have raised the rates on the stick-built housing world, and now they're meeting the interest rates of the manufactured housing world, the chattel loans, and we're neck and neck. And so somebody that's looking at maybe buying a $100,000 kind of not so great looking stick-built house at, let's say, 12% interest rate, could come over to us and buy a brand new, let's say 3-bedroom, $80,000, same square footage from us at the same 12% interest rate. Now, if it were me, I would rather do 80,000 than 100 or 120,000, right? Because my payment's going to be much lower on the 80,000. And 9 times out of 10, our lenders over here on the chattel side are only going to want anywhere from 5 to 10% down, depending on the buyer's credit. It's just we're going to see a little bit more challenges with their credit. We need to know that going in. We need to be honest with ourselves going into that. It's not a bad thing. It's just the nature of the business. And so if we know that, then we can have that conversation with our buyers and let them know that, hey, our lenders are going to want a minimum of 10% down. They may want more than that, but we know going in, it's going to be a minimum of 10%.